Hello, I'm Afsaneh Beschloss, CEO of RockCreek, meeting you today from Washington together with our eminent senior advisors, Dr. Alan Greenspan, one of the longest serving chairman of the Fed, and currently working very hard on his book on the economic history of the US. Also with our other eminent advisor, Liaquat Ahamed, who not only has been the CEO and CIO of a major investment group, but also is a historian and author and well-known, respected for his Pulitzer-winning book, The Lords of Finance. So it's a very interesting time to be having our quarterly call, and I am very much looking forward to hearing from both of you on a number of questions. Dr. Greenspan, you were the person who, before anyone else was talking about Korea, it might have been even like 2 years ago almost, more than a year and a half ago, started telling us to watch Korea. You were worried about the risks of Korea. What do you think going into the meeting?
And I think there's several facts which I think are really important and must be recognized. One is, what does Korea look like from a satellite at night? And I don't know if either of you have seen that picture. It is fascinating. You can literally see the lights on in South Korea, and as you get to the DMZ and beyond, it's black. That says they have no electric power, they have no GDP to speak of, and everything is essentially a small, very small economy. And the question is, what can they do about it? And the one thing which would be obvious is we can find ways to help North Korea become a vibrant South Korea type economy. The only problem is they have to break their regimes in part, because you cannot have a 21st century economy which is not which is not functioning.
We've been telling our European allies that we're putting on tariffs on aluminum and steel. Going into this G7, what do you expect? Do you expect anything major to come out of it, or both of you?
The trade issue is basically US and China. China is the major exporter, we are the major importer. And it's, for goods, it's remarkably dominant. Those are the two forces. And so you've got a situation where the United States is trying to figure out how to make this issue come together. And there is no simple solution as it stands now. You're living in two different types of environments. We essentially have iPhones. They've got blast furnaces. The technology is hugely different. And we can, for example, produce an iPhone that sells for $1,000. We could basically buy with that the amount of physical effort required, the number of hours. We can buy a big chunk of the steel industry. And so why would we want to go back to an earlier stage? And the answer is, that's where the political base of Donald Trump is. And he is a good politician. I must admit, he pulled it off, and it's an extraordinary thing. He's done some things which I think are actually quite good, but that's basically because he got the people who are advising him.
The orders of magnitude are too small to call it a war. Maybe you call it a skirmish, maybe you call it, the initial shots of a war, but, and that's, that's good, that I don't think it has the potential at the moment to derail a global economy which is actually doing pretty well. And since it doesn't make any economic sense, you have to say it must be being done for political reasons. And grabbing the headlines by saying, I am attacking foreigners because all of our problems are due to an unfair trading system, probably gets him some votes in certain areas. So I don't think anything will come of the trade war, but I think we've ended up angering our allies, because we've not only picked a fight with China, we've picked a fight with the Europeans and with Canada. So this does not bode well for a global, for sort of global cooperation. On the other hand, despite all that, the global economy, and particularly the US economy, is on fire.
And Alan, when you look at the tax cuts that we just had, looking at the positive and the negative, where do you fall on those taxes?
Well, I ask myself, where did the tax cut structure come from?
Right.
It's called Ireland. The Irish, remember, had basically a marginal corporate tax rate of about 35%. And they had enough sense to realize that being at the bottom of the heap, in order to move, they had to attract new industries, new companies alike. And what they did is they cut the corporate tax rate, as we did, or I should say that we followed them, from 35 to 12%. When you remember, we're looking at the bottom line. We're not looking at a complex cost structure. It's dollar for dollar. You cut pre-tax profit. You're given pre-tax profit margins, and the tax rate will determine what your after-tax return is. And the Irish experience was really dramatic.
But when you look at wages and labor, for example, Walmart, I think, was the company that is now letting large numbers of their workers get free education, college level education, right? Other employers are giving people special bonuses and things like that. But this does not then show up in your labor cost, right? The fact that they're spending money on their workers' education.
The point at issue is from an individual corporation. They link them because that's
for them in their accounting.
Yeah, but the unit labor cost and the unit money supply are the officially used data. In other words, you look at unit money supply, it fluctuates like this, and the price level goes. Milton Friedman was right that inflation is everywhere and under all conditions a monetary phenomenon. And the basic trend of way economies are functioning is very much related to the money supply in the system, but only up to a point. And and it's been extraordinarily off message, so to speak, in the last 4 or 5 years.
I think the laws of economics are going to reassert themselves. We are going to get signs of inflation. The Fed is going to tighten much more than the market is discounting. And as a consequence, we're going to go through a standard business cycle. There's a good chance that the Fed is raising rates at the end of next year above 3% to 3.5%, 4%.
So one of the things that I thought would be great to get your thoughts on is Dodd-Frank, Volcker. What we're finding interesting in RockCreek is that we invest in private lending and credit, and in the private lending area, there's so many opportunities, and they don't seem to be going away. And these groups are taking away the business from the banks, and the banks are not yet there to be doing what banks are supposed to do, which is lending to businesses. Do you think that as the regulation sort of gets, is it going to be a good balance, first of all, because you need at least to keep the banking system safe?
I think that what we now have, we have enough information going back into the last century to indicate that the necessary and sufficient conditions for a crisis is a toxic asset which is funded in a highly leveraged situation. And we can see, going back now, we now have the 1929, 2008. We've got there are actually very few incidences, because it's the problem with this. But they all seem consistent with those two requirements. Instead of going to Dodd-Frank after the 2008 crisis, I've argued, and I would do so in this book as well, that we should recognize that it's contagious defaults that are at the root of a financial crisis, all the time under no qualification other than that. And so how do you prevent contagious defaults? And the issue is that you significantly raise the proportion of bank or financial intermediary assets that is supplied by equity capital.
Dodd-Frank tried to imposed all of these very onerous regulations on behavior, which are incredibly difficult to police, particularly when some of the regulations are not what you do, but why you did what you did. Right. And it's very hard to regulate things based on people's motivations. It did raise equity capital requirements on financial institutions, but very modestly. Yeah.
But do you see the deregulation or some of these things getting taken off the table is going to get banks to help the economy grow more by doing the job?
I worry about the thing that you were talking about, which is direct lending.
Right.
Because
they're not subject to the same.
Yeah, there's a fundamental problem, which is you impose capital requirements on banks, and someone starts something which they don't call a bank, but for all intents and purposes is a bank, and starts doing banking business. Right. And people basically skirt regulations, including capital requirement regulations, and it's you're always chasing a moving target. So I worry about the level of all of this hype with direct lending that currently exists.
And in addition to direct lending, by the way, and some of our venture investments, what we're seeing is companies that are replacing mortgage companies by, you want to get a mortgage, I'll co-own the house with you, and I will own a piece of the mortgage
that's
with you.
Sort of okay, because that's people are, they're taking on equity risk.
Right,
and
exactly.
So I'm actually fine with that. So I'm not against sort of financial innovation of that sort. But look, I don't think the next crisis is not going to be a repeat of the last crisis.
Right. The market is underestimating future increases, and everyone is assuming very orderly 25 basis point increases in the next year, but that could be an underestimation. What are your thoughts?
So we're currently at 1 3/4. 2%, so another 25 basis points is baked in the market is expecting one more move to 2 1/4 by the end of the year. So it really only ever got to sort of 3. For a while it flirted with the idea of 4 rate hikes this year. It's sort of stuck with 3. I think they're wrong. So I think, because I'm positive about growth, I think the Fed will probably tighten twice more this year. So we could get rates at 2.5 by the end of the year. What is also striking is the market is expecting Fed funds to cap out at around 2.5. And that, it seems to me, is too low. So I don't know when, but I just think some point in this cycle, the market is going to get very disturbed, and because I think rates are going to cap out at more like 4%. And the market is, where the market is seriously underpricing things is where rates end up going by the end of the cycle.
Maybe we should move to Europe. That way you can both talk. How about that? You know, Europe grew quite a bit last year, more than the market expected. This year, it sort of plateaued a little bit. Mr. Draghi is talking about things being better than expected. What do you think is going to happen in Europe on interest rates and on sort of their...
I am very concerned about the euro. People don't spend enough time looking at what is called Target 2. Target 2 is the clearing mechanism for the individual central banks that make up the Eurozone. The trouble with that simple matter, which is we think would have no real importance because it's an overnight clearing system, is that the Bundesbank has built up $900 billion of credits. And coupled with Luxembourg, which is essentially a combination of a steel mill and German bank branches. Those are the two major credit sources. On the liability side, as you would actually expect, is largely Spain and specifically Italy, but also, shockingly, the European Central Bank itself. And so that you have the odd thing, if you consolidate the system, Germany is lending to the ECB. That's what the data showed. Now that is an unstable situation.
Moving on to emerging markets is another area of interest, and we have just at RockCreek launched a Frontier Fund and a MENA Fund, and it's been very interesting to watch emerging markets because they're within emerging markets. The last 2 years were really great years. This year has been less of a good year, but within this year even, there's such a huge divergence between countries. You have Saudi Arabia and Colombia experiencing really huge, improvements in their equity markets, and you have Argentina and Turkey having major, major problems. So there's big differences. The other thing that is happening, obviously, is with U.S. interest rates and the impact on the countries that have dollar-driven, dollar-based debt. There has been quite a bit of selling of their emerging market debt in the markets. Sort of looking at emerging markets, I mean, we think that in the long run they're a great place to be. What are your thoughts about emerging markets, particularly given what's going on in the U.S. and Europe and the rest of the world?
I'm not sure it makes sense to have a category called emerging markets now.
Anymore?
Yeah. The differences between them are as great as the differences between them and developed markets. So the idea that you can lump all these guys together and that their assets are going to move together is probably a relic of the 80s and 90s.
Brazil and South Africa?
Right.
Yeah, exactly. And so
You're absolutely right. Also, China is going to probably become its own separate category.
I think the thing is, China is 3 economies in one. There's the old traditional agriculture, which is what keeps them poor. There's this industrial to use Alan's reference, this industrial 1950s steel and aluminum economy. And then there's this high-tech economy. And it's sort of juggling all 3. And I suppose when Alan talks about disappointment, he is struck by how much of the old public sector economy has been allowed to persist. But you know, you go to China, and what is striking is the dynamism of the technology economy.
The new economy.
Yeah.